Today I want to talk about how Gary Gensler and the SEC are finally going after Ken Griffin and Citadel Securities. Now Gary knows the SEC will end up being sued by Ken Griffin, but he's decided those crimes have gone on for far too long. So stay tuned and let's make some money. But before I dive in with the key information, be sure to drop a like down below, subscribe to the channel and ding that notification bell. Now, if you're currently sat on the sidelines and you haven't yet started investing, Moomoo will help you get started with 15 free stocks worth up to a whopping total of $30,000. If you are already investing, the Moomoo platform is likely easier to use and offers more advanced tools for free than any other platform out there. And now I want to dive straight in with the key information. So, Tara tweeted saying the SEC chair, Gary Gensler, is launching a regulatory investigation into Ken Griffin's Citadel Securities. Now you may say, Tom, wasn't Gary Gensler worried that every hedge fund, the New York Stock Exchange, and most of those market makers out there will sue him if he goes after Ken Griffin and Citadel Securities? As Stonks Batman tweeted, Doug Cifu, the CEO of Virtu Financial, said that everyone will sue. Doug Cifu, whose firm is a leading intermediary that executes retail stock trades, said in an interview that it would be like a conga line to the DC core. Gary Gensler obviously has these plans for the market. He's going to implement these plans. He's going to punish these market makers like Citadel Securities. He is going to be taken to court, but he's going to try his very best to do all that he possibly can to win the court case. Gary knows that he's going to be taken to court, he knows that it's going to be a tough battle, but he's still going to implement these changes regardless because he knows these crimes have gone on for far too long. Now this article from Politico talks about why Biden's SEC chief is enraging Wall Street. It says Wall Street's top regulator is pursuing the biggest overhaul of the $51 trillion US stock market in 2 decades, but first he'll have to fend off a major industry resistance campaign. SEC chair Gary Gensler, a former Goldman Sachs partner turned progressive icon, is set to launch a regulatory broadside in the coming weeks against brokerage and trading giants including Charles Schwab, Robinhood and Ken Griffin's Citadel Securities. It says the rules that Gensler is spearheading would revamp the stock market's plumbing, partly in response to the 2021 meme stock saga, in which Robinhood and other brokerages attracted scrutiny after they were overwhelmed by trading in shares of companies such as GameStop and AMC. It says he's expected to crack down on the complex web of payments and fees that exchanges, brokerages and trading firms share when processing investors' stock trades. But while the proposals have yet to be released, industry executives have already begun talking about suing the SEC over those plans. And even a growing number of Democrats are urging Gensler to proceed with caution, signalling a potentially treacherous political road ahead, even among members of his own party. Clearly these Democrats and even these Republicans, basically all of the members of Congress, are evidently stressed about him taking away payment for order flow and basically screwing over Wall Street. Many of these members of Congress make most of their money from Wall Street directly or from profiting off the back of Wall Street trades, and therefore they're clearly unhappy about Wall Street being screwed over. But regardless of the pushback Gary Gensler is receiving from these market makers, from his own party and from all of the members of Congress, he's still deciding to implement the plans regardless. It says billions of dollars are on the line at some of Wall Street's most powerful firms. Now SEC officials have talked about rewriting the trading rules for years without making any major changes. But Gary Gensler has evidently decided that crimes have gone on for far too long and major changes are needed. It says the expectation is that this is going to be significant. Gensler likes to go big and I suspect he is looking to make his mark here on our equity markets. It says the SEC chief has talked about half a dozen possible reforms, so not just about changing payment for order flow, but half a dozen different policies. Among them are changes to the way stock trades are priced on exchanges like the New York Stock Exchange and NASDAQ. It says only about half of all trading in the market today occurs on stock exchanges, with the rest taking place through banks and brokerages, running private markets and handling the trades themselves. Therefore, clearly Gary Gensler is also interested in going after these dark pools and not just payment for order flow. Gary Gensler has also discussed more disclosures about how brokers execute client orders, aka if these brokers are delaying these orders and posting them through the system another day or even a few days later. So again, that's clearly something that Gary Gensler is concerned about and something he wants to rework. This way, orders won't end up being parked and going through in those after hours periods. They will be going through when trades are actually made, impacting the price and pushing the prices up further. Now obviously Gary Gensler hasn't yet announced exactly what he wants to change, and he obviously hasn't implemented any changes so far, so we'll just have to see exactly what happens over the coming few weeks and the coming few months. Whether Gary Gensler will actually make these changes and work for the retail investors and protect the retail investor is yet still to be seen, but I am interested to see exactly what happens in the future. I also think it's something that is absolutely needed. As Edward Burchard tweeted, he said Citadel Securities LLC is constantly violating Regulation SHO and the Securities Exchange Act of 1934. And as a quick reminder, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 15 free shares worth up to a whopping total of $30,000. He said, but because of acceptance, waiver and consent, they don't have to admit their wrongdoing nor actually stop their wrongdoing, they just pay a small fine. It says here Citadel Securities LLC failed to close out of a failed to deliver position in one equity security within the prescribed time. Citadel effected a short sale in an equity security for which it had not closed out a failed to deliver position without first borrowing or entering into a bona fide arrangement to borrow the underlying security. Now that violated C2 Rule 4.2 and Regulation SHO Rule 204, but as a result Citadel was only handed a censure and a monetary fine in the amount of $10,000. Now that is obviously just one instance of Citadel Securities violating Regulation SHO and only receiving a small fine of $10,000. From that FTD position that they failed to close out of, that could have been a short position or a synthetic short position worth hundreds of millions of dollars, where they made hundreds of millions of dollars of profit. And as a result, Citadel were only forced to pay $10,000 as a fine as a result of all of those profits, practically a speed bump. Now, as I said, that's just one specific instance where Citadel has actually violated Regulation SHO and been caught and fined for it, but there's also thousands, if not millions of times where they've violated that same ruling but not received any punishment. Even if they had received those punishments, they would only be receiving a small fine of $10,000 for each occasion they were actually caught, making off with millions, if not billions of dollars. And this is exactly why Gary Gensler needs to rework the plumbing of the overall market, removing payment for order flow and removing, if not changing, dark pools entirely. Now I also wanted to show you this video of Tucker Carlson standing up for what's right on Fox News.
Civic stock will decline in value. That's called short selling. Short selling has no obvious value to the American economy. Short selling exists for the purpose of enriching the people who do it. Short selling hurts companies, obviously. It hurts their investors, hurts their employees. Ultimately, it hurts our country itself. Yet it continues. No one does anything about short selling. Regulators ignore it. CNBC applauds the brilliance of the people who do it. Oh, they're so clever, those hedge fund managers. In fact, NBC's Business Channel regularly lends its airwaves to unscrupulous short sellers who use free TV airtime, you may have seen this, to tank American companies for profit. They do that all the time. The last administration did nothing to stop this. The current administration certainly won't. The Biden White House is more tightly controlled by business interests than any administration in history. Virtually every person there is beholden to the finance establishment. What's happening on Wall Street is so clearly awful and so obviously destructive. The question is...
Now, as you can see from that video, that was a recent interview or a recent speech given by Tucker Carlson as he was talking about the Biden administration. I think that's really interesting that that interview was shown on the mainstream media. Yes, it was shown on Fox News and not CNBC or one of those other mainstream media platforms. We know the majority of mainstream media is actually owned by these hedge funds who would never allow an interview like that to be shown on air. But I do think that Tucker Carlson is absolutely right there, standing up for what's right, because short selling has no real benefit to the US economy, it just damages and destroys American companies. Now I also wanted to quickly talk about Sears, which you may have already seen is actually poised to finally exit bankruptcy. Now the reason why I want to talk about Sears is because Sears was a stock regulated to the OTC exchange, obviously as it went bankrupt many years ago, but the Sears stock actually ran up on January 27th, 2021 and June 6th as well. At one point, Sears was up over 800% and is so far still up 66% for the year so far. Now, interestingly enough, one of the directors of Sears is actually a DTCC director as well. Adam Aaron was also previously tweeting about Sears, as has Ryan Cohen as well. We know that Sears was likely destroyed by these hedge funds and forced into bankruptcy with a giant wave of synthetic and naked shorting. It is very possible now that Sears is coming out of bankruptcy, it may be relisted on the New York Stock Exchange or the Nasdaq instead of being listed on the OTC markets. Therefore, at that point, shares may be actually available to buy for us, the retail investors. We could potentially push the price of Sears up massively, causing a wave of liquidations onto these hedge funds. As Neil tweeted, the Sears Holdings bankruptcy estate has now sufficiently repaid the former CEO's hedge fund and other lenders based on properly calculated collateral valuations. Therefore, Sears has appropriately paid off all of its creditors, it has some money left, and therefore it can emerge from bankruptcy. Sears may again be able to start trading if they issue a capital raise and us, the retail investors, buy up those shares. The Sears company would then be able to grow again, the price of the stock would be pushed up massively, and many of these hedge funds would end up being liquidated. Don't forget, as I've spoken about on the channel before, these hedge funds and short sellers wouldn't have ever closed out of their short sale positions on Sears because they could take collateral loans against those open positions. That way they never have to close out of their positions and they never have to recognise any profits and they never have to pay tax on those profits. These hedge funds can simply take out cash loans against their open, unrecognised profits and use that cash to further invest in stocks. As these short positions are still open, those unrecognised profits could be wiped out if the Sears stock sees a massive rise in price. If those unrealised profits are wiped out, those loans will be recalled by those lenders and these hedge funds will end up going bankrupt. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.